This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 381. This episode is brought to you by SoFi, helping medical professionals like us bank, borrow, and invest to achieve financial wellness. SoFi offers up to 4.6% APY on their savings accounts, as well as an investment platform, financial planning, and student loan refinancing, featuring an exclusive rate discount for med professionals and $100 a month payments for residents. Check out all that SoFi offers at whitecoatinvestor.com/SoFi. Loans originated by SoFi Bank, NA, NMLS 696891. Advisory services by SoFi Wealth LLC. The brokerage product is offered by SoFi Securities LLC. Member FINRA, SIPC. Investing comes with risk, including risk of loss. Additional terms and conditions may apply. All right. Those of you on YouTube might have noticed that I'm wearing something different today. I'm wearing a cowboy hat. The reason why is because I recently bought a cowboy hat and I feel like wearing it. We actually went to a Kenny Chesney concert, which was really good as part of our 25th anniversary extravaganza. But before we went there, we had to stop at a Western wear store and get some cowboy boots and a cowboy hat. But we got another use for these cowboy hats that we bought. We're going to wear them next spring. Okay, and we want you to come and join us. And you can bring a cowboy hat if you want. You don't have to, but it would be fun if you did, because WCI Con 25 is in Texas. Okay, it's right outside of San Antonio at this pretty awesome resort. You're going to love it. But the reason I'm telling you today is early bird tickets are going on sale. Okay, early bird is the best price you can get. Well, I guess that's not true, but it's the best price you can get now. You could get about that price at the end of WCI Con 24 as well. But you can get this price now through September 10th, August 19th through September 10th. This podcast drops on the 22nd. So right in the middle of that period, you save $300 off your registration to WCI Con 25. For a lot of you, you're using CME money anyway. That gives you $300 of your CME dollars that you can use to buy something else. Not many doctors have people to discuss financial challenges with. People who can relate to having student loans hanging over your heads, paying what seems like too much to the tax man, or feeling burned out of doing something that you've wanted to do since you were a kid. I've found that spending time with those who truly understand is one of the most important parts of our physician wellness and financial literacy conference. I hope you'll join us February 26th through March 1st, 2025 in San Antonio, Texas. Don't miss out on our lowest price. You save $300 on registration. This is truly my favorite event of the year. Most people who come say it's the best conference they've ever been to. And I love hearing about your successes and challenges personally during breaks, dinners, and all the fun wellness activities that we do there. At WCI Con, you surround yourself with people who actually get it and talk with the physician finance leaders you've followed for years. You'll learn a lot. You'll have an incredible time. Remember that the biggest threat to your career and your finances is burnout. And this conference is the closest thing you can get to buying burnout insurance. You know, when we first started it, I thought, we'll just put some wellness stuff in there so we can qualify for CME credit so people can use their CME dollars to buy it. What I've discovered over the years is people love the wellness content even more than the financial content. And it's a significant part of the conference. And you're not getting it anywhere else. It's super high quality, awesome speakers, awesome events. We do all kinds of fun stuff. You'll see as you look at the registration materials, lots of fun activities. We tend to knock off the conference about 4:00 and just go have fun together. And it's great. But Hill Country, Texas, is a perfect destination to get away for a break from medicine. And new this year, we're excited to offer 20% off for your partner's conference registration. Over 150 attendees signed up on the spot at the end of last year's conference. You're not going to be alone at this conference. We know at least 150 people are already coming. But I promise that this is the best use of your CME funds. Go to WCI Events for all of the details and to take advantage of the early bird sale. There's plenty of links to that all over whitecoatinvestor.com as well. But now's the time to sign up. This is the time to save some money and on your conference attendance, crush burnout, and improve your financial plan all at the same time. And you can even wear a cowboy hat and nobody's going to make fun of you. All right, you can take the hat off now. We're excited to announce we made it into the top 10 podcasts in the business category. Thank you to everyone who took the time to nominate us. Our goal has always been to help spread financial literacy, and this nomination is helping us spread awareness of the white coat investor and further our mission. The second round of voting has begun. It's kind of a funny process. How it works is out of all the people who voted in the first round, a select number of those people will be asked to vote in the second round. It is random and we have no idea who gets invited. So check your emails. And if you have an email from the People's Choice Podcast Awards, please take 1 minute and vote for us again for the final round before the end of the month. Thanks again to all of you who helped us get nominated. All right, let's get into your questions. Our first one comes from Carrie, and let's listen to it off the SpeakPipe. By the way, if you want to leave us a question, you go to whitecoatinvestor.com/speakpipe. You can record up to 90 seconds of a question. You don't have to use all 90 seconds. Record your question, and we'll try to get it answered on the podcast.
Hi, Dr. Dolly. This is Carrie from Virginia. I am a project manager, not a physician, but you've provided a lot of information that's relevant and helpful to me, so thanks for that. I'm currently helping a friend review and evaluate the investment mix in her 403B account. I'm aware that a 403B is sort of the nonprofit world's equivalent of a 401k, but I'm not well versed in the particular differences beyond that. I've read that whereas 401k accounts are typically held at investment companies, 403B accounts are often held at insurance companies. Why is that? I imagine this has something to do with using annuities to replicate what a pension would provide. But in this modern era where pensions have become so much less common, is there a current reason for 403B accounts to be managed by insurance companies? My friend's 403B is through her current employer, a nonprofit organization. The account is held at a major insurance company, but her investment mix is a collection of mutual funds. I have an inherent distrust of mixing investments and insurance, but in the 403B world, is it just normal for an insurance company to be involved? Should I set aside my bias? Beyond the investment mix of mutual fund investments themselves, which are all actively managed rather than my preference towards index funds, what would you be watching out for in this type of scenario? Thanks for your inputs.
Thank you for that question, Carrie. That is a great introduction to a subject that we should talk about. There is a big mess, not only in the 401k world, but in the 403b world. It's particularly bad for educators, it can be bad for nurses. Sometimes it's bad for physician employers. They're bad 401ks too, though. It's really a bad idea if you're an employer to offer a lousy 401k or a lousy 403b. You actually have a fiduciary duty to your employees to offer them, the best retirement account and investments that you can. They can sue you. And they have successfully sued their employers for offering crappy 401ks and 403bs. So keep that in mind. If you have any power, any position, any ability to improve the retirement accounts at your job, you do have responsibility there. 403bs are technically annuities, I think, by their actual legal definition. And that's more historical accident than anything. Obviously, they are more common in the nonprofit world, as you noted, but none of that really matters. All you have to decide if you're an employee is your 401k or 403b good enough to use, right? Is it good enough to use? If it's not, then you're stuck just investing in your Roth IRA, your spouse's accounts, and your own taxable account if it's truly not good enough to use. That's actually pretty rare, though, in my experience, for a few reasons. One, if the employer is giving you a match, it has to be an absolutely rotten 401k, and you have to be stuck with it for many decades in order for it not to be worth using, at least enough to get the match, right? Your match is free money. If you don't put enough money into the retirement account to get the match, it's like leaving part of your salary on the table. It's just dumb, okay? Don't do that. The second reason is lots of people are not stuck in that lousy retirement account for very long. If you're only there for 1 or 2 or 3 or 5 years or something like that, the additional fees of a crummy 401k or 403b, the additional expense ratios of the crummy actively managed mutual funds that are in there don't matter as much as the big tax deduction that you're getting for having the money in there and the additional asset protection you're getting for having the money in there. So the shorter the period of time that you're stuck in a bad 401k, the more likely it is that you want to use it. But if you're stuck in something for many years, you're going to be with this employer for decades, you can't get them to improve the 401k, how bad does it have to be before you don't use it at all? And my best guess, my best estimate is if the total fees you're paying between the expense ratios of the mutual funds and the additional fees into the 401k is 2% or higher, then it's not worth using long term. And most of them aren't that bad. you're paying 0.8% or 1.2% in mutual fund expense ratios, and you're maybe paying a little bit more in 401k or 403b fees. It is probably still worth using compared to just investing in a taxable account. So while you can try to get your employer to improve it, you can point out they have a fiduciary duty to you and they're opening themselves up to legal risk. In the meantime, you probably ought to keep using it, and hopefully it improves while you're there as a result of your efforts or those of others. So I would not avoid this. I know you just looked at your friend's 403b and you're like, wow, these all suck. And it's true. Some of them have all terrible mutual funds in them. But chances are, if it's like most of them, there's something in there that's reasonable. There's some sort of a S&P 500 index fund where the expense ratio is only 0.3 or something. Well, maybe they can build around that, right? They put all their U.S. stock money into that fund, and they use their Roth IRA or taxable accounts or their spouse's accounts to round out their asset allocation for bonds or for international stocks or whatever else they want to own in their portfolio. And you can still find a use for that 403b with a halfway decent investment. So that's the way I would look at it. When I'm talking about don't mix insurance and investing, yeah, that's a good use of that term, is to avoid having an insurance company running your retirement accounts. But mostly we're talking about buying products like annuities and whole life insurance and that sort of a thing that are kind of combined investing insurance accounts. It's just a place where there's a lot of products designed to be sold, not bought. A lot of high commissions, a lot of lack of transparency in general. Not a place you want to be with your retirement dollars. But in the case of a 403b, you're probably still going to want to use that. All right, our quote of the day today comes from Thomas Jefferson, who said, "Never spend your money before you have it." It's interesting. He was much more conservative on that policy than Alexander Hamilton was. That was a big duel among some of our founding fathers. And it turned out that Hamilton actually ended up putting the financial system in place that helped our country. But I think on a personal note, there is a great deal of wisdom in not overextending your credit, not spending your money before you have it. Doesn't necessarily always apply in the same way to a nation that has the ability to tax. Okay, our next question off the SpeakPipe. Let's take a listen. We're going to talk about someone with multiple 401ks.
My name is Andrew, and I live and practice in Indiana, which has some pertinence to my question. My situation: I am a 60-year-old physician whose career has led me to have 3 401ks, the latest one a solo 401k, as I'm primarily a 1099 contractor now. My question is about consolidating all of the 401ks to my solo 401k at my favorite bank brokerage. The benefit is simplicity and better options for investing. My specific question is in 2 parts. The first part: is there a significant risk from hackers or criminals? If I had my eggs in 3 baskets and there was a cybercrime, only 1 basket would be breached. The second part of the question: is there an asset protection risk? The main old 401k is over $2 million. Your book, The White Coat Investor's Guide to Asset Protection, page 42, states individual 401ks have non-ERISA status and have limited protection from creditors and bankruptcy. Restating the second part of the question: should I keep the old employer 401k for asset protection?
Okay, what a great question. Thanks for coming to us with that. One great reason a lot of people hold on to a 401k, well, a couple of reasons, right? Traditionally, most people, not white coat investors, but most people, when they leave an employer, they roll their 401ks into IRAs, right? Just for convenience, just to consolidate, just to reduce complexity, to have more investment options and better investments, lower fees, etc. Most people, that's what they do. White coat investors don't do that for the most part because they want to preserve the option to do a backdoor Roth each year during their earnings years. Backdoor Roth IRA. And in order to do that, you can't have any money in a traditional IRA, or your conversion step of the backdoor Roth IRA process gets prorated. So that's reason number 1. Reason number 2 is if you've separated from your employer, you can actually get into your 401k starting at age 55 with no penalty, as opposed to an IRA where you got to wait until age 59 and a half. None of that applies to you. as a 60-year-old doc who's talking about rolling money into a solo 401k anyway. So that doesn't apply to you. As a general rule, yes, you want to reduce complexity, not increase it. Is there risk there that somehow your 401k is going to be, stolen from? I guess there's some tiny possibility of that sort of a thing. Have good online security practices, right? Use good, 15-digit long random passwords in a password manager like LastPass or something, and use two-factor authentication. For instance, I got an email from Vanguard last week, and Vanguard's like, hey, somebody tried to get into your account, so we've locked it down. You don't have online access anymore. And I'm like, well, that doesn't sound good. So I called them up, and sure enough, someone had gotten my username or figured out a username and was trying to get into my account. Well, they couldn't guess my 15-digit or whatever it is password, so they didn't get into the account, much less they couldn't do the two-factor authentication. But it seemed like a good time for me to change both my username and my password. And so I did that. I think that risk is really, really low. It's not worth the complexity of maintaining 3 401ks when you don't need 3 401ks. So when you leave a job, what most white coat investors do is they roll the 401k into their new 401k or 403b. If the one you're using now is a solo 401k, for the most part, I would do the same thing. There is a difference in asset protection, though, in some states, right? A solo 401k is not an ERISA account. So it gets essentially the same asset protection as IRAs do in your state. It doesn't get the federal ERISA 401k 100% protection in the event that you declare bankruptcy. I don't think that matters very much in your case for a couple of reasons. One, you're 60. Presumably, you're not going to practice until you're 85. It sounds like you may not be practicing all that much longer anyway. And when you stop practicing, a lot of your risk of being sued goes away, right? Yes, you can still be sued from an auto accident or someone trips and falls on your property or gets hurt on your wake boat or whatever, right? But a lot of the risk we worry about as docs is malpractice risk. And when you stop practicing, that goes away pretty quick. Yeah, there's a couple of year statute of limitations. And if you work with kids as a OB or as a pediatrician, it could go until they turn 18 in 2 years or whatever. So there is some ongoing risk there, but it gets lower and lower and lower each year. The second reason is you're in Indiana. In Indiana, not only is your 401k 100% protected if you had to declare bankruptcy, for some above policy limits judgment that wasn't reduced on appeal, you get to keep that entire 401k. And in Indiana, you get to keep your entire IRA. In Indiana, you also get to keep your cash value life insurance cash value. You get to keep your annuity. You get to keep your HSA. And then you get $19,000 of your house. So not much house protection in Indiana, but if you'll thumb in the end of your book to the Indiana specific asset protection laws, you'll see that they're pretty darn good compared to most states. So if I were you, I'd just roll it all in a solo 401k. I would not worry about it. I think you got plenty of asset protection there. I don't think it's a huge risk of your solo 401k being hacked and all your money being taken away. But if you're really worried about that, I guess it's reasonable to split it between a couple of accounts. Make sure you're using real passwords, a different password for each account, obviously, different usernames for each account if you can as well, and use two-factor authentication. That way they've got to not only have all your information, but also your phone. And I think that's adequate. I mean, how many sleepless nights you want to have worrying about risks like this? These are the biggest risks in your life. You need more risk in your life. Okay, next question comes in by email. Mega Backdoor Roth is the title. I have a question for you regarding the Mega Backdoor Roth IRA. My wife and I have W-2 incomes that put us at a marginal tax rate of 37% federal plus 10.75% New Jersey state for a total of 47.75%. It kind of stinks. 50 cents of every dollar that you're making's going away. The tax man. My wife has a 1099 side gig where, depending on the year, she has $42,000 to $46,000 of additional gross income with $5,000 to $8,000 of business expenses or deductions. My question is whether it is better to deduct the business expenses and invest that money into a taxable account, or forgo the deductions and put the entire gross income as a Mega Backdoor Roth contribution, pay more taxes now, but get tax-free growth going forward. We're in our mid to late 30s to give you a sense of our investing horizon. And presumably some mega savers if you're in your mid 30s already and thinking about this stuff. Well, first of all, don't pass up business deductions, right? A bigger 401k contribution is not worth missing out on a business deduction. The best income you can have is business deductions. I mean, you don't want to like spend money the business doesn't need to spend, but a business deduction is not susceptible to any sort of tax, right? You don't pay income tax on it. You don't pay payroll taxes on it, nothing, right? It's great. So claim all of your business deductions. There's very little reason not to claim a business deduction. As a general rule, you pretty much claim anything you can that is a legitimate business deduction every year. Okay, the other that's unrelated though. You've somehow related these two things: to deduct the business expense and invest the money in a taxable account, or forgo the deductions and put the entire gross income as a Mega Backdoor Roth contribution. Now, these are totally separate things. Claim your deductions, then decide how you're going to invest your money. And even if you claim the deductions, there should still be something you can put into the solo 401k. There's three options, right? There's if you don't have any other income, you can make your any other job with a 401k there. You can make your employee contributions into the 401k as basically the first $23,000 you make. It can be Roth, it can be tax deferred, your choice. After that, you could either do, or a combination of the two, but either do employer tax deferred contributions, and that works out to be about 20% of what you're paid, of what your profit is in that sole proprietorship. Or you can do Mega Backdoor Roth contributions, right? These are after-tax contributions that you then convert to Roth. And you can typically, if you're not making $200,000 or $300,000 in this sole proprietorship, you can make bigger Mega Backdoor Roth contributions than you can employer tax-deferred contributions. So I would claim all your business deductions, and you can make the rest as a Mega Backdoor Roth contribution. That likely makes sense in your case. Hope that's helpful. I hope I answered that. Yes, it stinks that you got to pay 48% on your money before you put it in there, but at least after that, it's never going to be taxed again. Now, a little bit more difficult question might be worth, are you better off putting some money into a tax-deferred employer contribution and the rest in taxable, or all of it into Mega Backdoor Roth? My sense in your case, from what I know from the paragraph you sent me, is you're probably better off in the Mega Backdoor Roth. But it's possible it could be the other way, and you'd have to run the numbers with all the various assumptions that apply to you. It would be a really complex calculation requiring numbers that are not only unknown, but unknowable. But you could do that if you wanted to. But my sense is the Mega Backdoor Roth is going to be smarter for you. Okay, let's take another question off the speak pipe. This one from Nicole.
Hi, Dr. Dolly. I am Nicole, and I'm calling from the Pacific Northwest. I am an ER doc. I just had a question I was hoping you can answer, and we do really appreciate all the financial information that you've given us over the years. So we recently moved and transitioned from a large corporation that was a W-2 job to a tiny little independent ER that I am contracted as a 1099 contractor. I found your information about financial information for 1099 contractors, and I've been finding it very helpful for this transition. I have some healthcare for my husband, pays the estimated taxes, have my own disability and life insurance, and we seem to have figured out some of the little pieces that go along with this transition. But I do have a couple of questions. One, what do I do with the 401k from my old employer? I know that this is typically rolled over into an IRA, but I don't know what happens if I do a backdoor Roth IRA and how that affects it. And two, I also started a Roth 401k, a solo Roth 401k, and I was wondering how this is normally set up, because it seems like there's a lot of options. Do you just use one investment options? Do you try to use a lot of investment options? Are all of the options that are put into it tax deductible? Does it matter if I put more money towards an employee or the employer side? I really appreciate your help. Thank you so much. Bye.
All right. Congratulations, Dr. Nicole. You can call me Dr. Dolly. I'm going to call you Dr. Nicole on your change to being self-employed. It is scary the first time you do this. After a while, it's routine. So all these questions that you have that seem so hard right now, you're going to look back on in a year or two and go, how did I even have that question? That's so simple. I can't believe I didn't know that. But at the beginning, none of us know this stuff. And so you got to learn it. First of all, the 401k from the old employer, right? As I mentioned earlier in the podcast, doctors, white coat investors, are high income earners. The only way they can do their Roth IRA contributions is indirectly via the backdoor Roth process. And as part of that, you don't want to have any money in an IRA. So we don't roll our 401ks into IRAs until we're done working. We roll them into the next 401k or 403b. In your case, since you're no longer an employee, your next 401k is a solo or individual 401k. And so you will roll your 401k from the old corporation into your new solo 401k. One reason you may not want to do that is in your state, you said Pacific Northwest, but I don't know exactly what state. I guess we could look up Oregon and Washington and see what their laws are. Let's do that really quickly. I've got my asset protection book. If you haven't bought this, by the way, I think it's a great deal. You ought to buy it just for access to the lists at the end of it. But let's go to that list for Oregon. And we see that IRAs in Oregon are protected 100%. So that pretty much applies to non-ERISA retirement accounts like a solo 401k. So no big deal for you to roll your 401k into a solo 401k if you're in Oregon. Let's look at Washington. In Washington, IRAs are also 100% protected. So go ahead and roll your money into your solo 401k. All right. Now that is the main retirement account that you are going to want to use as a sole proprietor, as self-employed, as a 1099 contractor, whatever you want to call it, is a solo 401k. So you want to establish one of those. Sounds like you already have. I don't know who you opened it up with, whether you got a customized one from one of our sponsors like mysolo401k.net, whether you got a cookie cutter one at Schwab or Fidelity. But either way, most of them will offer both tax deferred contributions and Roth contributions. And so you said you'd established a solo Roth 401k. That doesn't happen. That means you also have a tax deferred 401k. There's two sub accounts in there. In a really nice one, you have a third sub account, the after tax account. And that's where you can do Mega Backdoor Roth contributions if you want to. But yeah, so this is the way it works. Is a certain set of investment options in there? If you've got a customized solo 401k, they should all be good. If you're going for the most part to Fidelity or Schwab, there's plenty of good ones available. You don't have to use them all. But remember, when you're putting together a written investing plan, which I'm pretty sure you don't have based on the way you asked your question, the first thing you consider is your goals, right? You make SMART goals, specific, measurable, time relevant, time bounded goals. That are things like I want to have $4 million on January 1st, 2037, right, in my retirement accounts. That's the sort of goal you want to have that you're working toward. Then you choose which accounts you're going to use. In this case, one of the most important accounts is going to be this solo 401k. Next, you decide on an asset allocation or mix of types of investments. And maybe you decide I want 30% US stocks and 20% international stocks and 20% real estate and 30% bonds or something like that, right? So you've decided on the mix of investments. Then finally, you select investments that will put your money into those categories, right? To distribute your money among the various investments, the various asset classes that you want to invest in. You don't have to invest in every mutual fund in your 401k. In fact, it would be really weird if you did that. But some people who don't know anything about investing, that's what they do because they don't know what else to do. And they feel like, oh, well, that'll diversify me. But you really want to have a plan. And you choose the investments to implement the plan in an appropriate way. If that's very confusing to you, I would recommend you do one of or both of two things. The first one is take our Fire Your Financial Advisor course. This helps you write your own financial plan. Although the first module in it is how to interact with the financial services industry. If that still seems overwhelming after taking a look at that, and you can take a look at it, right? It comes back with a 1 month or 1 week 100% money back guarantee. If you're like, no, this is too much for me, I need a financial advisor, well, go hire a good financial planner. We keep a list of those at whitecoatinvestor.com. If you go to the recommended page, you can check those out. And you'll pay somebody a few $1,000s to help you draft up a financial plan. And then they can help you implement it. You can implement it yourself. Obviously, the more they do, the more you pay them. But that's how you get your investing plan in place. And I'm guessing that would be beneficial to you to meet with somebody this year and kind of put a plan in place and have them teach you more about investing and portfolio management. And you may be able to do it on your own after that, or you may say, hey, you know what? I want someone walking with me in this journey, and I'm going to pay you something each year to help me with this decision. As far as the employee versus employer side, what most people generally do is they put as much in as they can as the employee contribution, and then they put in as much as they are allowed to as an employer contribution. And then depending on the solo 401k, you might also be able to make a Mega Backdoor Roth or an employee after tax contribution, get even more in there. The total amount for 401k for those under 50, which I'm guessing you are, is $69,000. And so most people are trying to get as close to that as they can if they're saving that much or more for retirement in a given year. Hope that's helpful to you. If that didn't clarify it, shoot me an email, editor@whitecoatinvestor.com, and I'll try to walk you through any other questions you have about that. All right, our next question is also about retirement accounts.
Hi, Jim. I'm wondering if you can help me clarify a point of anxiety about my husband's retirement account. We will both be staying at our institutions as attendings after graduating residency in June 2024. While in residency, his hospital offered a 401k match, but mine didn't. So we just invested a combined amount of our available income in his retirement plan, in addition to maxing out Roth IRAs while on resident salaries. His plan is through TIAA, and employee contributions go into a tax-deferred annuity retirement plan. Employer contributions go into a separate retirement plan in the same account and online system. Your warnings about annuities on your podcasts have made me concerned about this being called an annuity, but I'm wondering if it being in a tax-protected retirement account makes it not the typical annuity that you warn us about. From what I can tell, it functions just like any other retirement account, and there are good investment options. Can you help either dispel my anxiety or guide me on what I should do if this is a bad thing? Thanks for all you do.
All right, very similar question to the one we had from Carrie earlier in the podcast. Yeah, let me dispel your anxiety. This is not something you need to spend a lot of time worrying about. As a general rule in the retirement account world, TIAA is generally considered one of the good guys. So having TIAA doing your retirement account is usually not a bad thing. Are they my favorite? No. Would I rather see a whole bunch of Vanguard investment options in there instead? Yes, I would. Or iShares or some of the low-cost Fidelity index funds or some of the low-cost Schwab index funds or ETFs. Would I rather see those? Yes, I would. But TIAA is not considered a bad provider of retirement accounts. When you're at a nonprofit like you are, and you typically have a 403B like you do, those are technically annuities. And so you're going to see that word anytime you're reading literature in your retirement account. Good job, by the way, on a couple of things. One, reading the literature about your retirement account. Two, figuring this out during residency, that you were better off just contributing to your husband's retirement account and doing Roth IRAs. A lot of people can't figure stuff like that out, and you did. So, well, good job. Good on you for doing that. But this is not something you need to be worrying about. Go ahead and use this retirement account, max it out, and put your money in there. When you get a chance to roll it over to a solo 401k or a better 401k, then be sure to do that, of course. But this is not something you should feel any anxiety whatsoever, much less avoid, because the word annuity is there in your retirement literature. As general, when we're talking about annuities being products designed to be sold, not bought, and things that you avoid, we're talking about other things than 403Bs. By the way, for those of you out there dealing with this stuff, thank you so much for doing it. It's the fact that you're having to deal with TIAA or a 403B means that you are in some sort of service profession. You're a teacher, you're a nurse, you're a doc at a nonprofit. Those sorts of things are the places that have 403Bs and TIAA. So not only are you out there, dedicating your life to the healing of the sick and afflicted, but you are doing so often in a nonprofit kind of capacity. So thank you so much for doing that. All right, next question. This one's on a 401k from Will. So maybe Will isn't at, a nonprofit, but let's take a listen.
Hey, Jim. This is Will from the Midwest. I have a question about 401ks. I work primarily in a K1 partnership, making approximately $350,000 per year. I also have a 1099 gig, which I just started, which I could make up to $200,000 annually if I work a lot of hours. I still occasionally moonlight as a W-2 employee in a hospital, PRN, which I make up to around $20,000 annually. My K1 partnership offers a 401k. I'm maxing out traditional contributions with that. What that looks like on my pay stub each month is that I'm contributing $1,900 and I have a quote unquote match of $3,800, even though it's all my money. A financial planner I worked with has advised me to open a solo 401k to contribute my 1099 income towards. He says I can contribute up to 25% of my earned 1099 income into that solo 401k, meaning about $50,000 of traditional contributions. I didn't think I could do that because I thought I'm already contributing to my K1 401k as both the employer and employee, but he advised this is not true. If that's how it works, I'm wondering if I can also contribute to my W-2 403B. There's no match for my W-2 PRN gig, but it allows me to contribute up to 80% of my earnings into the traditional 403B, which means I can contribute about $16,000. Thanks again for all that you do.
Okay. Great case study of a not atypical physician situation. This sort of situation is super common among docs. It is not common among typical Americans. And so most financial advisors don't know how to deal with this. For the most part, your advisor actually gave you good advice. So it is true. You can have more than one 401k. I have a blog post on the website you should read. If you just go to the website and search multiple 401k rules, you will find it. And it walks you through all of these rules for using multiple 401ks. But the two main ones to keep in mind are that there are two contribution limits. One is the employee contribution limit. And for those under 50, this limit is $23,000 per year. And that limit applies no matter how many employers you have or how many 401ks you have. It's $23,000 per year. It can be Roth, it can be tax deferred, but you only get $23,000 per year. Technically, if you have multiple 403Bs, you can actually put in a little bit more. You just don't get a tax deduction for it. So putting in a little more gets you more employer match. It may be worth it, even though you're not getting a tax deduction for it. Okay. So here's the deal. In your case, what you would typically do is you'd use the partnership 401k. You'd put your employee contribution in there, and then you'd use self-matched money to the employer contribution. You'd get up to $69,000 a year. I think that's what you're doing with your K1 partnership. Nice work. That's great. For the 1099 income, you got to open a solo 401k, an individual 401k. And you've already used your employee contribution. So you can't make an employee contribution in there. So this is where we come to the second important rule about multiple 401ks. And that rule is that for each individual unrelated employer, you get a separate 415C contribution limit. The 415C contribution limit is $69,000 a year for those under 50. And it includes all contributions to the 401k. That's employee contributions, employer contributions, and employee after tax contributions. The limit $69,000 a year. Okay, so in your case, you could make employer contributions, no employee contributions, but employer contributions to that solo 401k. You made about $200,000 in profit. That means you can put in about $40,000 into that solo 401k as a tax-deferred employer contribution. Note that that is 20% of your profit, not 25%. This is where your financial advisor gave you bad information. When you read the tax forms, a lot of times it says 25%, but what they mean is 25%, not including the contribution. So 20% of $200,000 is 40 grand. 25% of $200,000 is 50 grand. Okay. But if you take out the $40,000 contribution, you're left with $160,000, right? 25% of that is $40,000, right? So that's how it works out. So in your case, you can max out that one at your partnership. You could also put $40,000 in tax-deferred employer contributions into the solo 401k. If you wanted, you could put another $29,000 in after-tax employee contributions. These are Mega Backdoor Roth contributions, right? And the plan has to allow it. That's why a lot of us get customized solo 401k plans. But that would allow you to put in another $29,000 in Roth into that solo 401k. Great deal for you. You're making lots of money. You want to save lots of money. This is a good option for you. Now let's talk about the other gig. You got a W-2 gig where you're making 20 grand. And you're telling me they're going to let you use the 403B. I'm not 100% sure that's true. You better go talk to HR and make sure that's actually true. A lot of times, part-time workers do not have access to a 401k or 403, but if they let you, great. However, what they are talking about, they're talking about an employee contribution, right? And you already use that up at your partnership 401k. So you would either have to decrease how much you put into your partnership 401k as an employee contribution and increase how much you put in there as an employer contribution, or you couldn't contribute to this other W-2 401k or 403b. Now, if you talk to them, they may They may allow you somehow to have employer match put in there, some sort of employer contribution, even if you don't put anything in. But that seems unlikely. There's one other rule to keep in mind, and it's kind of a little bit of a complex one. But if you have a 403B, not a 401k, and a solo 401k, those two actually share the same 415C limit. It's just this weird quirk of 403Bs. So if that W-2 retirement account is a 403B, that shares the same limit as your solo 401k, and maybe it's not worth bothering with. But I think you should definitely get the solo 401k. I think that's a good move. I'm not sure it's going to work out for you to do anything with that other side gig you've got, though. Hope that's helpful. Hope that's not confusing. Those of you who are confused by this discussion, go to the website, go to the search bar, put in multiple 401k rules. That blog post will pop up. It goes into great detail on all these things I've talked about, as well as some other related things. Okay, let's take a question from Chris, who wants to talk about cash and bonds.
Hi, Jim. I have a question about the use of cash versus bonds in a retirement portfolio. Specifically, I've noticed some approaching retirement who use a portfolio split of equities and cash. They cut out bonds altogether. This deviates from the traditional allocation that typically would have a split of equities and intermediate term bonds, with maybe a touch of cash in there. I know there are many roads to Dublin, but what are the trade-offs in using this cash over bonds method? Thanks for what you do.
All right. A good way to think about cash is that it's just a very, very, very short-term bond, right? They're both fixed income, both pay interest. The principal fluctuates with a bond. The interest fluctuates with cash. So they're not dramatically different. And for the last year or so, might be pushing 2 years now, we've had an inverted yield curve where the yield on cash and short-term bonds is actually higher than the yield on intermediate and long-term bonds. And so that tempts lots of people to go, well, if I can get a higher yield, why don't I just use cash instead and not take that interest rate risk? And that's a great question. And that works as long as the yield curve doesn't change. But if the yield curve does change and interest rates fall, you would have actually been better off buying the bonds. Obviously, if interest rates rise, you'd be even worse off with the bonds. And so that decision a lot of times depends which one's going to work out better for you over whatever time period, depends on what interest rates do. And without a functioning crystal ball, that's very hard to tell. And so the traditional teaching is, hey, stocks and bonds, maybe a year or 2 or 3 worth of withdrawals in cash in a portfolio. That's a very traditional way to manage money. It's basically what my parents do with the money I manage for them. Works just fine. But some people are like, well, I want to try to time this decision a little bit. I'm going to stick with cash because cash is paying 5% and my bonds are only paying 4.5% and they're riskier. If things change, well, I'll change what I have. And that's not a crazy thing to do. Just realize if interest rates fall, especially if they fall rapidly, you would have been better off in the bonds. And that's about all there is to it. Cash isn't wrong. Some people do go, well, I'm gonna have stocks and cash, and that's it. Sometimes because the cash is such lower risk than bonds, they decide, well, I can have less cash and have the same amount of risk, right? So they have 80% stocks and 20% cash instead of 75% stocks and 25% bonds. And maybe there's something to that, taking your risk on the equity side where it's a little bit more tax efficient. But that's kind of the traditional teachings. There are many roads to Dublin, as you say. Neither of those is right or wrong. But those are kind of my current thoughts on cash versus bonds. If I knew what interest rates were going to do, I'd tell you which of those you should be holding right now. But since I don't, it's anybody's guess. I'd just pick percentages you're comfortable with sticking with long term and rebalancing back to that once a year or so. All right, as I mentioned at the top of the podcast, SoFi is helping medical professionals like us bank, borrow, and invest to achieve financial wellness. Whether you're a resident or close to retirement, SoFi offers medical professionals exclusive rates and services to help you get your money right. Visit their dedicated page to see all that SoFi has to offer at whitecoatinvestor.com/SoFi. One more time, that's whitecoatinvestor.com/SoFi. Loans originated by SoFi Bank, NA, NMLS 696891. Advisory services by SoFi Wealth LLC. The brokerage product is offered by SoFi Securities LLC. Member FINRA, SIPC. Investing comes with risk, including risk of loss. Additional terms and conditions may apply. All right, don't forget WCI Con 25. I got to put the cowboy hat back on here. We're going to Texas, y'all. We're going to have WCI Con down there. Physician Wellness and Financial Literacy Conference, right? They're on sale now. Best price you can get, August 19th through September 10th. It's $300 off. Don't forget to go. You can sign up at whitecoatinvestor.com. WCIevents.com is actually the place you end up signing up for. It's going to be awesome. We're having some great wellness activities every day in the afternoon. It's just a lot of fun. It's a big party. It's either tax deductible or you can use your CME money to pay for it. You're going to come back feeling more well, feeling like you have tools to deal with burnout. You're going to come back with some ideas for improving your financial plan that are likely going to pay for the conference itself, as well as all your time down there. And you're going to be inspired. And perhaps most importantly, you're going to make some friends that can help you, stay the course with your financial plan and reach all of your financial goals. And this year, you get to wear cowboy hats. So I'll bring a cowboy hat, I'll wear mine, and we'll have a good time. WCIevents.com is where you sign up. You have until September 10th to get the best price on it. Obviously, we're going to let you pay right up until the end, unless for some reason we sell out. We don't think we're going to sell out completely. We've got enough space there. We think we can expand as needed. But if we do, you'll really, really regret not signing up early. We have sold out in the past before, but it's been a few years. All right. Thanks for those of you leaving us 5-star reviews and telling your friends about the podcast. One comes in from Doug, who said, great podcast. WCI should be required reading and listening in med school and residency. I started listening around 2016. And I've listened to every episode since. I've learned so much. I'm now retired from medicine and still enjoy listening, reading, and learning from both the WCI podcast and blog. Thanks for the great work, helping us docs keep our finances on track. 5 stars. Thanks for the great review, Doug. That really actually does help us spread the word to other people. Still listen to the podcast, get their financial ducks in a row, and have all the happiness that money can buy in this life from getting that taken care of. Keep your head up, shoulders back. We'll see you in San Antonio, y'all. You've got this. We'll be here for you. See you next time on the podcast.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.